Most income investors want the same thing: enough cash flow to cover their bills, a dividend that keeps up with inflation, and a portfolio that does not blow up when the economy gets rocky. Simple goals, but finding stocks that genuinely deliver all three at the same time is harder than it looks. Because when a stock does yield 5% or more, there is almost always a catch. Maybe the debt load is unsustainable. Maybe the dividend is barely covered by actual earnings. Maybe the company has no growth and the high yield is just the market telling you something is wrong. I ran a screen with a demanding set of filters: yield of at least 5%, 10 or more consecutive years of dividend growth, a raise of at least 3% over the past year to keep pace with inflation, an investment-grade S&P credit rating of BBB+ or higher, and a dividend safety score indicating low risk of a cut. Very few stocks cleared every bar simultaneously. Today, I am walking through the 4 most interesting ones that did, what makes each compelling, what the real risks are, and what the honest picture looks like for income investors building long-term portfolios. If you are building that kind of portfolio and want analysis like this every week, hit subscribe. I post honest dividend breakdowns consistently. And before we get into the 4 names, quick question for the comments. When you are evaluating a high-yield dividend stock, which single factor matters most to you? The yield level, the dividend growth rate, the credit rating, or the payout coverage ratio? Drop your answer below. I reply to every comment, and I genuinely want to know what this audience prioritizes first. The first stock is Prudential Financial. Prudential has a 5.4% dividend yield, a safe dividend safety score, an S&P credit rating of A, strong investment grade, and raised its dividend by 3.7% earlier this year, keeping pace with inflation. The company has been in business since 1875. It is one of the largest life insurance providers in the world, with approximately $1.5 trillion in assets under management across its insurance, annuities, retirement solutions, and growing asset management divisions. The dividend track record reflects that durability. Prudential has raised its payout for 17 consecutive years, essentially every year since recovering from the 2008 financial crisis, when the dividend was cut in half. That crisis came because life insurers like Prudential entered it carrying too much risk in variable annuity books that guaranteed minimum payouts regardless of market conditions. Today, the business is more diversified. The annuity book carries fewer guarantees, and the asset management arm is growing while requiring less capital than the older businesses. A repeat of that level of stress on the dividend looks significantly less likely. The one specific issue weighing on near-term earnings is the Japan business. That division generates around 40% of company income and is currently dealing with employee misconduct issues affecting approximately 100 employees and around $20 million in client damages. New sales in Japan have been suspended through November, while management overhauled compensation systems and oversight. This is expected to hit earnings by 5 to 10% this year, and somewhat less next year. But here is the important context. Around 90% of the Japan unit's profits come from existing policyholders rather than new sales. The core income stream is largely protected, even while growth in that market is temporarily constrained. The payout ratio sits around 40% of expected earnings, well covered even with the earnings headwind. The valuation is currently near the low end of the 5-year average PE range. For income investors who want a durable, century-old business at a 5.4% yield with low single-digit dividend growth ahead, Prudential checks most of the boxes with eyes open to the Japan situation. The second stock is Paychex. Paychex offers something genuinely rare in high-yield income investing, a combination of high starting yield and high dividend growth simultaneously. The current yield sits just over 5%. The dividend was raised by 10% recently. The dividend safety score is safe. The credit rating is BBB+, and the consecutive dividend growth streak has now reached 15 years. The business provides payroll processing, HR management, benefits administration, and 401k oversight to small and mid-sized businesses. These are not optional services. They are essential, deeply embedded. And switching providers is a significant operational disruption that most small business owners will avoid unless something goes seriously wrong. That stickiness shows up directly in the financials. Earnings have nearly tripled over the last decade. Sales have nearly doubled. Operating margins run around 40% consistently. The balance sheet carries very low leverage. The stock has been punished severely, It is trading near 52-week lows. The forward PE has collapsed from a 5-year average of 27 to just 16 times earnings today. The reason is AI. The market is pricing in the risk that AI tools could eventually allow small businesses to run their own payroll and HR without paying for a platform like Paychex. That is a legitimate question worth taking seriously. But payroll is genuinely complicated. Tax compliance and employment law across multiple states carry real liability risk for a business owner who gets it wrong. The cost of paychecks as a percentage of operating expenses is small. The cost of a payroll error is not. Paychex is also integrating AI into its own platform. Clients can already run payroll via voice or email commands. The near-term earnings growth outlook of around 8% remains solid. The business is still generating reliable recurring cash flows. The dividend is well covered and was just raised by double digits. This is a high-quality business going through a fear-driven valuation reset. I have held this position for over a decade, and I am sticking with it while watching customer retention and growth metrics closely. The third stock is NNNREIT. NNN REIT has a 5.4% dividend yield, a 3% raise last July with a similar raise expected this summer, a dividend safety score of 80, firmly safe, and a BBB+ credit rating from S&P. It is a mid-cap net lease REIT with around 3,700 mostly freestanding single-tenant retail properties leased to approximately 400 tenants. The largest single tenant represents only around 4% of total rent. The portfolio is deliberately concentrated in sectors resistant to e-commerce pressure. Automotive services at 19% of rent, convenience stores at 16%, restaurants at 8%. You cannot get your car serviced through Amazon. The triple net lease structure is what makes the business model so cash flow efficient. The tenant pays property insurance, maintenance, and taxes on top of rent. NNN collects its rent with extremely high margins and predictable income. Average remaining lease terms run about 10 years. The AFO payout ratio has held very close to 70% for the past decade. Healthy coverage with room for continued increases. The dividend track record is exceptional. Nearly 40 consecutive years of payout increases averaging consistent 3% annual growth across both the 5 and 10-year periods. With the current payout ratio near the low end of its decade-long range, there is room for continued raises even if cash flow growth stays modest. Analysts expect around 4% cash flow growth in the year ahead, which comfortably supports the upcoming summer dividend increase. On valuation, NNN is currently trading roughly in the middle of its 5-year average yield range. Not a screaming bargain, but not stretched either. This is the kind of stock that rarely gives you a perfect entry point because of how predictable and stable it is. Think of it as a defensive near bond-like holding that consistently outperforms fixed income. You get steady income of a bond, but with annual dividend growth that protects your purchasing power over time. The fourth and final stock is Enterprise Products Partners, ticker EPD. EPD has a 5.6% distribution yield, an A- credit rating from S&P, the highest of any midstream energy company in the sector, a safe dividend safety score, and 3% distribution growth over the past year. One important note, EPD is a master limited partnership. Enterprise Products Partners is one of the largest energy infrastructure companies in the United States. Over 50,000 miles of pipelines, extensive storage facilities, and export docks along the U.S. Gulf Coast connecting to global markets. Its network touches almost every major shale basin in America and handles natural gas liquids, which represent roughly half the company's profits, plus natural gas at about 20% and crude oil at about 15%. The key to the business model is that EPD earns fees on volume moved through the infrastructure rather than on the price of the commodities themselves. Most contracts include fixed fees with minimum volume guarantees and annual escalators indexed to inflation. Despite oil and gas prices moving dramatically over the past decade, EPD's distributable cash flow per share has risen steadily and consistently. The distribution has grown for 27 consecutive years, averaging 3 to 4% annually. The payout ratio sits below 60%. Management has been conservative with debt throughout. The balance sheet has actually improved significantly over the past decade, supporting that A- credit rating. The honest caveat on EPD right now is valuation. The stock has run meaningfully on geopolitical tailwinds. specifically the natural gas liquids shortage created by Middle East tensions earlier this year. That has pushed the yield from its 5-year average of around 7.3% down to the current 5.6%. If you already own EPD, holding makes complete sense. Starting a new position at current prices means paying for a tailwind that may not prove permanent. I would wait for a more normal entry point before adding meaningfully. That said, as a long-term income holding in the energy infrastructure space, Enterprise Products Partners remains one of the most reliable and durable names available. Here is the broader framework from all 4 of these. Finding high-yield stocks that are genuinely safe is genuinely hard. Most stocks that yield 5% or more get to that yield for a reason, and the reason is often not a good one. The 4 names here cleared a demanding set of filters simultaneously. The yield is real, the dividends are covered, the credit is strong, and the growth track records are there. Understanding what is behind each of them is what separates an informed income decision. The question I want in the comments: which of these 4 do you think is the best risk-adjusted income opportunity right now, and which one would you be most cautious about? Name both and tell me why. I reply to every single comment. Hit subscribe for more analysis like this every week. Let us build something real.